Hey, welcome investors to the 40 Finance channel. Hopefully you're having a better day than I am. Me as a PayPal shareholder, it's been a bad day. So we started off yesterday about $175 a share. This is after the market meltdown. And right now looks like we're trending about the $130 line. All this coming after a mixed earnings report. There was some good news, there was some bad guidance though looking ahead, and that of course is the most important thing. So in this video I'm going to talk about some of the things that I picked up from the conference call and the investor deck, and let you know what my thought process is for my PayPal shares going forward here in 2022. All right, so on paper it's not a terrible headline for an earnings release. You got non-GAAP EPS of $1.11, misses by a penny. But revenue beats by 30 million. So as soon as I read that, I was like, oh, okay, let's get into the guidance and see where things go from here. And we'll skip this first part and get right to the point. Fiscal 2022 guidance: expect total payment volume to reach 1.5 trillion and revenues to surpass 29 billion. GAAP EPS projected to be in the range of 297 to 315. Non-GAAP expected to be in the range of 460 to 475 versus 526 consensus. So this ends up being the biggest line on this little synopsis, because not only did the 460 to 475 come in short of the consensus, which is always a dagger, but you basically have flat EPS growth here. And obviously if you follow this channel, you know that one of the things that I typically look for is double-digit top and bottom line growth. So I like to see the top line growing plus 10% or more, but I also like to see the EPS or the bottom line growing plus 10% or more. And in this case, PayPal, at least right now, is saying we'll have the exact same EPS next year. And that's what gets me a little frustrated right now. If PayPal lands at the low end of their guidance at 460, and the year before was 460, then the denominator of our PE ratio does not change at all. So in that case, in order for the stock price to go up, you need that numerator in the PE ratio to go up, and that, in this case, is basically the valuation multiple. And you don't have to be a genius to see that in the stock market right now, valuation multiples are not going up, they're coming down. You put those two things together, and in my opinion, you've got a tough situation setting up for 2022. All right, the other line on here that the street and the analysts are going to focus on is this net new active accounts. If you think about the Netflix stock fiasco here recently, Netflix hit all their numbers, okay, but people could not get over the fact that new accounts, that the growth of that was slowing. Now in PayPal's world, it's almost a double-edged sword, because not only is account growth slowing, which to me isn't like super surprising coming off of the pandemic, except the other side of the sword is they made this colossal goal that they put on all their investor information that said we are trying to target 750 million active accounts. All right, so from an account standpoint, here's where they sit. They got 426 million active accounts at the end of 2021. So they did increase that by 13%. The problem is it's going to take a long time growing at 13% to get to this goal that they published for everybody of 750 million accounts. As a matter of fact, on the investor call and somewhere in this deck here, they retracted that goal. Okay, so bad look there. And the account world got even better on the conference call, because they talked about deleting 4.5 million accounts that they said were either like illegitimately created or just for whatever reason had zero value. Now, I for one appreciate that they trimmed some of the fat out of the account numbers, because that game has always been ripe for disappointment on Wall Street. But the bottom line is you got really 3 strikes in the account world, and no matter what I think about account growth, Wall Street loves it, And we saw that with Netflix. When you can't put big account growth numbers on the board, you can pretty much expect your valuation multiple to trickle down, and I think that's what we're seeing here. All right, now I'm going to call out a couple things from the conference call transcript here, and it's a perfect time to call out one of the cool features here in SeekingAlpha, where they actually post the transcripts already written out and everything for you right on the website. It's not an immediate release. It takes a few hours for the transcript to get posted. It's a super handy feature, and I believe it's available for almost every single stock, certainly all S&P 500 stocks. Now, if you've been watching the channel for a while, you know that my affiliate link for SeekingAlpha is in the description. It gives you a significant discount on a 1-year premium membership. And that will get you into features like these, as well as many others that I use here on the show all the time. So check out the link in the description. Now for this, I'm going to dig into the details here with John Rainey's portion of the call, who is the CFO. We're going to do this last little bit on accounts just to make sure that you guys understand it. Then we're going to move on from the accounts. So let me get this here. In the fourth quarter, in connection with the increased use of incentive campaigns throughout 2021, we identified 4.5 million accounts that we believe were, it says legitimately created, but I believe it is illegitimately created. So obviously this is a transcript. There's going to be a couple errors in it, right? But what happened to our 750 million? In addition, we no longer believe that 750 million medium-term account aspiration we set last year is appropriate. Now the why behind giving up on the 750 is down here. We have a Pareto dynamic in ours where the vast majority of our volume comes from about 1/3 of our customer base. What this means is, unlike a subscription model where more users equate to more revenue, that relationship is much, much more attenuated. In assessing our marketing effectiveness, our engagement initiatives were more successful than incentivized sign-up campaigns, is what he's trying to say. We successfully move customers up the engagement continuum into higher levels of engagement. These strategies had strong returns over time and will be important contributors to achieving our long-term revenue per user objectives. So I'm going to pause right there and say this is actually like long-term good news. Revenue per user versus number of users is probably a much better way to run a business. And as Rainey states there in more than a few words, is just like, hey, we've noticed that if we got to 750 million accounts, then, we don't really know exactly how good that would be for our business. What we really need to focus on is getting each user to participate and bring us more revenue. So that is the revenue strategy in terms of users for PayPal. It's getting more revenue per user out of the system. Stop worrying about getting numbers, which some of those numbers or some of those new additions are going to equal 0 to the bottom line. All right, the last thing I'm going to cover here is the most important, right, which is revenue growth and EPS growth. So looking ahead, this is all about 2022. The impact of Omicron and the effect of inflationary prices combined with the lack of stimulus is having an impact on spending and by extension, our business. So remember, PayPal is connected to something like the top 75% of global e-commerce sites. And it's a little bit concerning to see that they're already talking about inflation, potentially Omicron, pulling back on perhaps what they projected was going to be stronger sales. On last quarter's call, we preliminarily indicated high teens revenue growth for this year and said if we had to pinpoint it, it would be 18%. Based on our more conservative stance today, we are starting the year with an expectation of revenue growth in the range of 15 to 17%. So with that statement there, I'm personally coming in on the low end of every single thing that PayPal management projects this year. Because we're having some misses, granted small ones, but I think you have to put the lower end of their guidance into your models if you're going to build out what you think the stock's going to land at. So let's just say 15%, that's not going to comp very well with last year. All right, so that's the top line. What about the bottom line? And this is where I get a little ticked off. I gotta tell you. So he's talking about earnings growth in 2022 and how it will be constrained by the lapping release of credit reserves and a very low effective tax rate last year. In 2021, we released $312 million in credit reserves. This benefited our operating margin by 125 basis points and basically increased earnings per share by 21 cents. Remember, this is in the past, okay? This has happened and it's not happening again. So right off the bat on that statement, we're losing 21 cents of EPS in 2022 that won't be comped. Our effective tax rate was 10.5% last year, resulting from favorable discrete items, settlements, resolutions, blah, 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 and benefited earnings per share by approximately 33 cents for the year. So in sentence number 2 here, we are now down 54 cents of EPS heading into 2022. So if they landed at $4.60 in 2021, non-GAAP numbers, which PayPal's been flying by non-GAAP for a while now, you talking about 10% of that won't be comped because of extraneous factors, right? Now, the low end of their guidance for 2022 actually also happens to be $4.60. The difference is last year, they should have probably reported $4.06, and then this year we would have got to $4.60 and at least shown some EPS growth. But instead, we're stuck in a year on an EPS side that we have to comp factors that cannot be replicated, right? And put on top of that, you have the e-commerce boom from COVID, which certainly was in effect in January and February of 2021. Probably not going to be able to comp that either. So it's a pretty tough year from an EPS standpoint. All right, the last part of my bear rant here, then we'll get into some projections. You know, the CEO led right off with the eBay news. And if you're not familiar, eBay and PayPal decided to go their separate ways a few years ago, but they sort of had a wind down plan in place. But what happened in 2021 and into 2022 is there was a projection for that wind down, right? PayPal had a sort of a timeline from a revenue perspective, like how each bit of the eBay business would dissolve and it would eventually be zero. But what happened in 2021 is that it dissolved faster. So when they were guiding for revenue and EPS and whatnot, the rate of the whole change was happening faster than anticipated. Now, on the bright side, some of the things that COVID brought us with more e-com activity, it balanced itself out, but they are calling out for sort of one last push from this eBay separation. eBay's migration to managed payments happened faster than we anticipated. Overall, eBay put $1.4 billion of pressure on the top line, reducing our revenue growth by 700 basis points. So the whole long-term goal when they did split from eBay was, of course, to grow replacement revenue for eBay. So some of these numbers, they kind of mix together and they muddle the growth story a little bit. So ex-eBay, our revenue growth was strong, growing at 29%. But you put the two together and it was whatever, 18% or so. Then looking ahead to next year in terms of eBay, eBay's transition will put $600 million of pressure on our top line, approximately $400 million in Q1 and $200 million in Q2. So it's good, it's going in the right direction, which they just want to be done with this thing. In the second half of the year, I look forward to being able to stop adjusting for eBay and letting the strength of our core results speak for themselves. That's a fairly important line if you believe it, assuming that they get to whole from an EPS standpoint, the eBay relationship will be fully dissolved and you'll start talking about just PayPal growth. You won't have to factor in eBay with it. And with that, they'll actually have a higher percentage of growth if things remain the way they have been. Now, in this whole mess of the stock melting down, there are more than a few bright points for PayPal, particularly if you have not bought into PayPal yet. So unfortunately, if you're at the $250 level, $200 level, I think it's going to take a while to get back there. However, if you're sitting on the sidelines, there might be some opportunity if the price drops enough for you. So as far as that opportunity in my eyes, looking back at their history, right now you got a forward PE of 33.40. However, this is based on analyst consensus. So what I put together is the low end of PayPal's guidance, which was 460. That's the number we've been talking about the whole time. So if we say 460, and I went back in history, and from 15 through 2019, PayPal had an average forward PE of about 30. It had a couple years that it dripped into the mid-20s, but I think 30 is a pretty fair valuation for a company that, at least on the top line, is growing 10%, and they're not shrinking a whole lot on the bottom line. So long story short, 30 for your multiple times $4.60, which is on the low range of guidance, that gives you my projected stock price of $138. Now, that's the short-term price target, and it incorporates the low end of their guidance and pretty much the low end of the valuation scale from a forward standpoint. So I'm going to call it $138, kind of like fair value, semi-floor kind of thing. And you're at 130.27 today. If I didn't own any PayPal, I would certainly want to get greedy here. I would maybe chop off another 10%. That puts you at like 117, 120 if you even get that opportunity. So for myself, I added a small lot of 3 shares today. And anytime that it's in the 120s, I'll probably be adding more small lots in that 3 to 5 range. My cost basis heading into this earnings report was $190. So I'm in bad shape for the short term. However, I still think there's room for a bull play here, and let's get into that. So one of the real highlights of PayPal stock, even after this drubbing, is really their cash flow. Okay, they have a lot of cash coming into this company. And you can see that on a forward basis, price to cash flow is 26 times. That's right in line with a Microsoft. So here's Microsoft, and we'll come down here. Price to cash flow looking forward. They're in the 25s. PayPal, I believe, was the 26s. So this is not a company that we're talking about bankruptcy, or we're worried that they're stuck because they don't have enough money and they can't innovate or do anything like that. In fact, quite the opposite. And that leads me to the bull case for PayPal, and the reason that I'm staying with this stock. I'm not interested in booking a loss on my $190 shares right now. First of all, it's freaking January, so it seems kind of dumb to take that loss right now, but also because this is supposed to be a 3 to 5 year hold for me. That's what I told myself when I bought it. We're barely in year 2. Okay, so I am going to give it some time. And when you think about that cash flow and you think about the Pinterest acquisition, which obviously they bailed from, but they certainly had their reasons, but it just tells you that they're out sniffing around. And I think it's that optionality that makes PayPal sort of intriguing. We also know that the Venmo product is basically still in its infancy and really doesn't produce any material wins for them in terms of revenue or profits. They're going to add Venmo to Amazon. You should get something out of that. I don't know how big it will be, but the bottom line is, with the cash war chest, with 75% of the top e-commerce companies, with Venmo and all the other things that we've talked about, I don't necessarily see this as an easy double down for myself because I'm so disappointed in the results. However, I am going to make myself pick off some small lots because I think there's still enough optionality with this company, particularly if we start talking about longer term, right? Where is the world in 2024? Where is the world in 2025? That's usually what you have to go through with stocks to get the best return We've kind of forgotten about that in this pandemic time, but I'm going to be patient and try to very, very slowly lower my cost basis. All right, guys, so that's my take on PayPal stock's earnings. Really was a slap across the face for me, and it's one of the reasons that I always say that I'm not telling you to buy PayPal, right? And I think I said that a lot leading up to earnings, that, you know, I thought the downside was $150. Okay, now we're already at 130. And 150 was my sort of like dead end. Now keep in mind, what did Netflix do? Down to 360 or something, and now you're back into the 420s. So if we can get some institutional money in this stock, okay, if we can get another Bill Ackman or some ETFs or something, it can bounce back. I don't think it bounces to $200. But we could see some action that gets it up to the 150, maybe the 160 range in the short term. All right, guys, hope you enjoyed the video. Please give me a like, subscribe, all the things if you did. Don't forget to check out the Seeking Alpha Premium offer down below. We'll see you on the next video.